Okay, so good day everyone. I made a promise when we released the theory part for market structure. I said we're going to do a short and a quick video to explain what the market structure really is. So very quickly in this lesson, we're going to be learning about the market structure. We are going to talk about the three major importance of structure. Apart from that, we are also going to be talking about the four structural points that we focus on as traders. We'll talk about what the break of structure is and what the break of structure is not. We are going to be considering the concept of the change of character. We'll talk about swing structure and internal structure. So I want us to quickly walk ourselves through these. So when we talk about the market structure is what helps us to understand the direction of the algorithm. As a matter of fact, we will not do well with understanding the concept and the narrative behind price movement if we don't understand what the market structure is. Are we together now? So, and that is one of the major importance of the market structure. It helps us to understand the actual direction of the algorithm. Apart from helping us to understand the direction of the algorithm, it gives us a clue into where liquidity is being engendered. I think I made it very clear in the last session that what actually causes movement in price is liquidity. So if we must understand the narrative behind price movement, then we must understand how that the market structure is being triggered. So usually there are three major importance of structure that we are going to quickly talk about now. Importance of the market structure. One of the very strong importance of the market structure is that it helps us to determine directional bias. It helps us to determine the directional bias. Are we together now? It helps us to determine the directional bias. I'm going to be explaining this very quickly. The second thing it does is that it helps us to identify continuation or reversal. It helps us to identify continuation or reversal. And then the third thing it does is that it helps us to understand where liquidity is being targeted. To understand where liquidity is being targeted. To understand where liquidity is being targeted. So now, what do we mean by directional bias? The word directional bias is the clue we have into where the market is headed. It gives us a clue into whether the market is going to be bullish in the next couple of weeks, couple of days, couple of minutes or hours, or whether the market is going to be bearish. So it is very important that before we take any trade, we have a predetermined bias, because if you don't know where the market is headed, what you are doing is gambling. Do we get it now? So, and we don't want to gamble. So it's important that we have a clue into the direction of the market. Is that okay now? Then the second thing it does is that it helps us to identify continuation or reversal. As a matter of fact, I don't think there's any solid way that we can identify continuation or reversals if we don't understand the concept of market structure. It is the market structure that will give us the idea of whether the market wants to continue in a particular direction or it wants to reverse. Do we get what I'm saying now? So another thing is that it helps us to understand where liquidity is being targeted. It helps us understand where liquidity is being targeted. It helps us understand where liquidity is being targeted. I think in the last class, I spoke about the concept of liquidity very well. I made it clear that liquidity is where money is hanging. Liquidity is where money is hanging. And one thing about market makers and the algorithm of the system is that it will always push price to the direction where there's liquidity. So anytime you notice that you have relatively equal lows, as a matter of fact, I'm still going to talk about liquidity very well. I think in the next class or next 2 classes, we are going to be studying the concept of liquidity. We will understand how to know where liquidity is. Because a lot of times people open trades and the market moves a little bit and then reverses and hits their stop losses. And then you see, there's this common saying everywhere that the market is seeing where you place your stop loss. No, the market is not seeing where you place your stop loss. The only thing there is that the market already understands where stop losses can and could be placed. So, and usually you discover that your stop loss will be at either the recent low, the recent high. So those are liquidity regions, and that is what and where the market is going to target. So these are the 3 major importance of market structure that we can overemphasize. It helps us to determine directional bias, to identify continuation or reversal, to understand where liquidity is targeted. Are we good now? So if that is that, let's quickly talk about the 4 structural points, and I'm going to be showing us these very quickly. Let's talk about the 4 structural points. We are going to check it. I'm going to give us an illustration of what it looks like. The 4 structural points. 4 structural points in structure, or let's say the 4 structural point in the markets. The 4 structural point in the markets. Are we good now? The first one is the higher high. First one is the higher high. Is the higher high. The higher high. The second one is the higher low. The third one is the lower high. Third one is the lower high, and the fourth one is the lower low. Fourth one is the lower low. Are we together now? So now these are the 4 structural points that we have in the market. Now let me give us an illustration of what I'm talking about. So usually when the market is bullish, when you have a bullish market structure, because there are 2 major types of market structure that we have the bullish one, and then we have the bullish market structure, and we have the bearish market structure. So let me use this plain space. So now when we talk about the higher highs and the higher lows, so let's say we have a bullish market structure like this. So the market is creating new highs, and then creating new highs like this, Can we see? And then on this side we have the market creating lows, and the market creating lows like this. So if this is what we have, now let me explain what I'm talking about. So if we look at this manual structure very well, you discover that for every move, there was a high, another high. So now when we talk about this market structure, if you check it very well, you discover that for every market structure, before every market structure can continue, this was a high, this was another high. But if you check it very well, this previous high is lower than this next high, and so this place we'll call it the initial high, and then this becomes the higher high, this becomes another higher high. Do you understand now? This is a low, but then the next low, which is this point, is higher than this previous low, so we call it a higher low, and then this becomes another higher low. So if I'm going to be labeling this now, I will say this is what? This is a higher high. I'll say this is a higher high. Do we get it now? A high. This is also a higher high. And then if we check this, this is a higher low. This is a higher low. So what do I mean? This is what is a higher low. This is a higher high. Do we get it now? So this is what we mean. So for market structure that is bullish, for bullish market structure, you discover that new highs will be created. So this is a higher high, this is a higher low. The next one will also be what? Will also be a new high, and so we call that a higher high and what? And a higher low. So this literally means that if we must understand market structure, then we cannot do away with these structural points. So if you check it very well, if I use a trend line now, you discover that this is a clear indication of what? Of a bullish move. The market is moving in the upward trend. So this is an uptrend market, and so the structural points that we're going to be having will be higher highs, higher lows, higher highs, and higher lows. Now, if this is what we have for a bullish market structure, this is an example of a bullish market structure. Now, the reverse is the case for your bearish market structure. So for a bearish market structure now, you discover that we are having new lows being formed. We are having new lows being formed. This is a low that was taken out, and then this is another low that was taken out. Do we understand now? So new lows are being broken, new lows are being taken out. And so that's the more reason why, if I'm going to be labeling this one now, I will say that this one is a lower low, a lower high rather. This is a lower high, and then this is going to be a lower low, a lower low. Do we get it now? So it means that looking at this market structure now, it is a clear indication that we are in a downtrend. It's a clear indication that we are in a downtrend. Is that okay now? We are in a downtrend. So if you look at it very well, this is a low that is lower, that is higher than this. So we call it a lower high. Then this one is a lower low. This low is lower than the previous low. Is that okay? Then this particular low is higher than this new low. That's why we call it a lower high. Do we get it now? So these are the four structural points that we have. We have the lower high, the lower lows, we have the higher highs and the higher lows. So if you check this, if I use a trend line now, you discover that this is a clear downtrend. It's a clear downtrend. It's a clear indication that the market is what? Is going down. It's a clear indication that the market is going down. That is what we mean when we talk about the four structural points. So using these same diagrams that I've drawn, let me quickly talk about break of structure and the change of character. You see, a lot of times people confuse the break of structure with the change of character. If you look at this very well, now one thing about break of structure is that we only say that structure is broken anytime we are having a continuation. So the major difference between a break of structure and a change of character now is that break of structure occurs when trend is to be continued. So this literally means that the only time we are going to be seeing a break of structure is when there is continuation of the previous trend. So this is an example of a break of structure. Why? Because the structure, this was a high, and then this was a high which was created by a strong bullish momentum, and then the market retraced. This is an example of retracement, retraced, and then set out again with a strong impulsive move. So if you check it very well, this is an example of a break of structure. Why? Because this is a continuation pattern. So if a break of structure must occur, it has to be in line with the previous trend. So here also, this is also another break of structure because it is in line with what? With the previous trend. So here we have a break of structure, we have a break of structure on this side, and we have another break of structure on this side. So now what break of structure does to traders is that it helps us to see that the trend is not changing. It helps us to identify the continuation in the market. So it's clear now that this market wants to continue going up. Do we get it now? So that's what break of structure is. Now it becomes a change of character. It becomes a change of character when it now takes out, let me show you what I'm saying now. It becomes a change of character when it now suddenly breaks the previous low. So if the market has been moving in an uptrend and then it now suddenly takes out the previous low, we refer to that as a change of character. So if this is a break of structure, we have a break of structure here, we have another break of structure here. So now the market went up and then came down with an impulsive move to take out this previous low. So this previous low has been compromised, and so we can no longer call this a break of structure. So at this point, what we now have here is what? Is a change of character. So if I will label this, I'm going to be calling this I'm going to be referring to this as what? As a change of character. I'm going to be calling this the change of character. So this is an example of a change of character. So we can see now the major difference between structural breaks and character changes. So when the market breaks below the previous low, because one thing about the market is that if the market wants to continue moving in an uptrend, smart money is going to ensure that they protect the lows, because that is where their liquidity is resting. Do we understand now? So if you check it very well, from here the market took out this high, it rallied up, and then it was coming down. It is not expected to take out this previous low, so the market took out the new high to continue in the same direction. So it continued in the same direction, came back down and went up again. So the smart money is trying to protect this low. So now if the market now takes out the low that should be protected by the smart money, it means that there's a change of character already. So this means that there are chances that the market will now begin to head in the opposing direction. So in order to be able to substantiate this well, I will advise that these structural points should be marked on a high or on a higher time frame. So for swing traders now, this structural point is expected to be marked on either the weekly or on the daily. For intraday traders, this structural point is expected to be marked on the 4-hour. While for scalpers, we will advise that this structural point is marked on either the 1 hour or on the 15-minute time frame. So that is how we go about it, because one thing about the market is that there are a lot of noise. So if we are using the lower time frame to mark out this structural point, there are chances that the market is taking out a low in order to be able to grab a liquidity. Do we understand now? That is the more reason why it is advised to always mark out these main structures on a high time frame, on a higher time frame. So now, having understood what the break of structure is and what the change of character is, now in between price movements, there are usually internal structures. So this is what I'm saying. Let me show us what I'm talking about. This is what I'm saying. Now, in between price movements, there are usually minute structures. You are going to discover that there will be internal structures that must be handled. There will be internal structures that must be handled. What do I mean? Let me show you what I'm talking about. Now, if you check this very well now, we can see that at this point, a higher high was created, another higher high. So here we expect that this should be another higher high, right? But then before this market continues going up, there are chances that it will create some minute internal structures inside before it picks up again. So now these minute internal structures cannot be referred to as a change of character, because that's where a lot of people miss it. There is a main structure, which is the swing structure. So for this particular illustration now, this is a main structure, this is another main structure. So it will be wrong for a trader to now pick these internal lows and highs as either a change of character, but although it can be seen as a break of market structure, but we cannot refer to this as change of character. So usually a lot of people mistake the break of a swing or the break of an internal structure with the break of a swing structure. So if the structure is about to change, then what we notice or what we observe is that there's going to be a break of the swing structure. Is that okay now? So that's the major difference between the internal structure and swing structure. Now let's quickly show ourselves this on chart. So if you look at this very well, let me go to the 4-hour time frame. If you look at this very well, what we notice is that at this point we have a bullish momentum. Let me show you what I'm talking about. This is a clear bullish move. So what we notice is that the market was creating, let me show you what I'm talking about now. What you notice is that the market was creating, this is a high, it's created a low. Can we see what I'm talking about? It's created a new high, created a low, created a new high. Can we see? Created a low, created a new high. Are we seeing it now? Created a low, created a new high. So this is what we are talking about. And then created a low, created a low. Do we get it now? So this is what I was talking about. So we can see the lows and the highs that was created. So this is an example of a bullish market structure. This is doing it on charts. Now let's look for a bearish market structure. So the market is bearish when new lows are being broken. So if you look at it on this massive base, so if you look at it like this, what you are going to observe is that there was a break of structure to the downside. Can we see? Then a new high was created. It broke down. Can we see now? And then created a new high. It broke down again. Created a new high. Broke down. So this is what we are talking about. Created a new high. So this is a clear indication of a bearish market structure. A clear indication of what the bearish market structure looks like. So that is that. Now, if you look at it very well, in between these structures, we can see that there are main structure. Now, this is an example of a main structure. Can we see? So what we do is that we try to avoid the noise. We try to avoid the noise caused by the internal structures. We avoid the noise caused by the internal structures. Is that okay? So this is an example of what? Of a main structure. So inside, until this structure breaks, there are chances that we might not be confident to take our trade. Is that okay now? So that will be all on market structure. And if there are questions, we can just enter my DM so that we trash out those questions. So that will be all for this week on market structure. Thank you.